G'day, Fools. Scott Phillips here, the Motley Fool's Chief Investment Officer, and welcome to another edition of Stocks in Focus. Can I tell you, this is one I've been looking for since we started this series a few weeks back. This is probably, I don't know if it's the most talked about stock on the ASX right now, but man, it must be close. It is big. It is exciting. It has been a rocket ship. And yet, has it overdone itself? Is it too expensive? I'm going to find out from someone who is the resident expert on the company that you know and I know as Afterpay. The ASX code is APT. Welcome, Ryan Newman. How are you, mate?
Thank you very much, Scott. Great, thank you. How are you?
I'm excellent. I'm going to try not to. I think the last time we chatted, my alarm went off during the broadcast or the taping. I'm going to try and avoid that this time. I'm going to try and be professional, mate. So let's dig in. Afterpay is, I'm not sure it's the most polarizing stock on the ASX, but man, it's got to be the most talked about. It has been a remarkably volatile ride from somewhere under $2 to 40, back to 8, back over 100. I'm not sure if I should date stamp and time stamp the price because chances are it'll change half a dozen times between now and when our viewers actually get to watch this video. Let's just say, mate, it has been all over the place. And it's kind of representative of not only the excitement of the company, but the uncertainty of the company. A really exciting place. I'm going to say, look, I don't own Afterpay. I don't even really have a strong view, which is why I'm asking you rather than giving you my view. But it's one of those companies that I've said before, we shouldn't underestimate what Afterpay has managed to do. Those people who are a little bit like me, have a little bit less hair or no hair or grey hair, will remember that there was a thing called Bank Card once upon a time. It was shut down by the Australian banks because they kind of looked around and went, there's Visa, there's MasterCard, there's Amex. We don't need another payment option. That's enough. And yet Afterpay has gone from this little software business, originally Touch Corp way back in the day, merged with Afterpay, became Afterpay Touch, now Afterpay. And it is. I mean, the task of muscling in against those global payment networks is just a phenomenal story. So whether the investment is great or bad from here, the first thing I want to say, frankly, is that we should celebrate these sort of success stories. Fortescue Metals, CSL, Afterpay. I think they're businesses that have just won against the odds. I want to say won again. There's plenty of game left to be played, but have done a spectacular job. Mm-hmm. Right, and just doing a wonderful. And look, hey, we love a little Australian company that can go to the rest of the world and actually change the way the rest of the world does business. And there's a gazillion buy now, pay laters popping up, and I'll ask you about that in a minute too. I'll give it a bit of a summary of the company. Let's actually take a half a step back though. Buy now, pay later is kind of obvious if you've used it. It's obvious to us because you and I talk about this company a couple of times a week, more or less. But let's break it right back. For those who don't have an Afterpay account, just give us a quick top-line sketch of what buy now, pay later does, what it offers, why it's different, and why Australian people seem to love it.
Yes, look, so buy now, pay later, it's really a modern day iteration, I suppose, of lay-by. So back in the day, you'd make ongoing payments prior to actually taking ownership of the item. Now It's actually the opposite. So what you're doing is taking ownership of the item, and then as the label says, buy now, pay later, you're paying for it over time. There's a whole bunch of different iterations of buy now, pay later. Most of them advertise themselves as being interest-free. Some of them charge a fee, so that might include like a monthly account keeping fee when there's a balance owing. Afterpay takes a slightly different approach, and it's really a pioneer in this sector. You know, one of the first movers. And what it does is it charges the users four fortnightly payments, equal payments over the course of either 6 to 8 weeks. It also rewards users for loyalty and for good behavior. That's I guess Afterpay in a nutshell.
Nice. And if you do it right, you don't pay a cent. The retailer kind of foots the bill, right?
Yeah, that's right. So the way that Afterpay makes money, the bulk of its money, is through the merchant. So what it does is it approaches the merchant and it says, look, we will charge you somewhere between 3 and 6% of the underlying sale. And in return, we will basically market your product, or we will provide the customer with another payment option. The reason that's attractive for them is because it does provide them with a whole lot of referral options. It also helps to boost their cart, helps to boost conversion rates. I can get back to some of those, I guess, those benefits later on. But yes, absolutely. From the customer's point of view, as long as they pay on time, there is very little to pay for them, or nothing to pay for them, in fact.
Nice, mate. I made a million mistakes in my investing career. This is one of the biggest ones, I have to say, because I remember years ago, when Afterpay maybe just first merged, seeing this one slide in their presentation where they talked about the retailer pitch. Well, they went to retailers and said, hey, using Afterpay, retailer X has grown sales by 60% or something ridiculous. And so, of course, retailers are going to jump on board. And honestly, like sometimes investing is hard, right? Sometimes you got to work out P&Ls and business models and all stuff. Other times you look at that and go, who was I kidding? Like, why did I just buy the shares at that point? So that will go down as one of my biggest investment mistakes ever, I think, in the fullness of time. But it is. I mean, the reason retailers love it is despite paying more for Afterpay than some other payment methods, the very proposition for the consumer is so overwhelmingly compelling that they want to pay the fee because the sales growth is frankly worth it, right?
Yeah, it is. And I mean, look, in history, people have gravitated towards credit cards and other forms of debt, whether that be a mortgage or whatnot. It does give them the ability to spend now, get what they want in the now, and then pay for it in the future. And buy now, pay later is really providing them with the same option, but what it's doing is it's I guess angling itself as a more trustworthy approach. And it's really taking that budgeting angle. So it sort of markets itself as a budgeting tool, particularly for younger people who do end up being its primary user base. And I think that angle is working for it. It's also innovating and creating new solutions that again I'll get to soon, which I think do help with that angle. Nice.
I will say, I editorialize very slightly to say that business model aside, as a financial advisor, I don't love the fact that they're teaching people to use debt to not delay gratification when investing is all about delaying gratification. I'm not entirely sure that the average Australian consumer at 16, 18, 22 is being benefited by the reality of it being there. Maybe it's still better than credit card, by the way, so I'm not suggesting it's not better than the potential alternatives, but I don't know. I'd rather teach people to budget by saving rather than spending, but that's a whole different kettle of fish, mate. Let's go to the more recent news because this is kind of we've done the background, we've done the what is it. This is, I guess I'll couch it by saying, as I mentioned before, there are not literally gazillions, though that's not an official term, of buy now pay later providers, but I reckon there's probably 8 on the ASX. If I was to round up, there's probably a good half a dozen or so more that we know around the world, including a firm in the US, Klarna in Europe, which Commonwealth Bank has a shareholding in, by the way. So there's all that, right? Afterpay have kind of invented or reinvented the category. Arguably, FlexiGroup was there first, by the way, but they've reinvented a category in a brand new way. There's a whole lot of imitators, would-be competitors. And then recently, speaking of would-be competitors, a couple of big businesses. A company called Apple, you may have heard of. A company called PayPal, which for full disclosure, I own shares in. They've kind of turned up at the party. Even Woolworths, which is not doing buy now, pay later, but it's launched its own digital wallet, I read on the news yesterday. This is a very, very big and very complex category. Before we get to the bull and bear case, just can you summarize where the payments landscape is at with Apple and PayPal kind of muscling in? Do you have a framework as to how you're thinking about the space? So we'll get into the bull and bear specifically, but if you think about the kind of the competitors, the kind of the space they're in, how things are placed, if you had to kind of summarize what's going on, could you do that for me in a couple of paragraphs?
Yeah, I actually wrote down, you mentioned a minute ago, there's a number of ASX listed players, and I wrote those down before. So we've got Afterpay,
nice. Well done.
We've got Zip, We've got Laybuy, Hum, which was FlexiGroup in the past.
Okay,
we've also got Sezzle and OpenPay. So I think that's 7.
That's 6, I think.
Count, or 6?
Okay.
6.
6. I think I counted 6, but yep.
And I'm sure there's more that aren't listed.
Can I split it?
Sorry, say again.
Is Split It one of the companies? I think I've heard of Split It as well.
Yeah, I think there is Split It as well. So yeah, I think that is 7.
Anyway, there's plenty.
there are plenty. There's no shortage. Yeah, I suppose in a sense, I guess what a lot of these companies are doing is providing a payment option for consumers, right? And I think one of the ways that Afterpay is differentiating itself, and sorry, I'll go back a minute and say again, you mentioned a minute ago that PayPal and Apple are both expanding into this space too. And I think what they're doing too is just providing that payment option. They're providing convenience and really trying to take a clip of the overall transaction. So when you use Apple Pay as an example, Apple will get a very small percentage of that transaction fee. And that contributes to a very, very large service base for Apple. It's worth tens of billions of dollars. So it's very lucrative for the business. Where I think Afterpay sort of differentiates itself is as a buy now pay later provider. What it's really doing as well is providing a platform to connect merchants with consumers and vice versa. And one of the reasons that it is charging a higher merchant fee than what someone like PayPal or Apple will, I think I saw PayPal was going to charge about 2.6% plus 30 cents or thereabouts. Whereas by comparison, Afterpay is probably more around somewhere the 3 to 6% mark. So it is significantly higher. But at the same time, I think a lot of merchants probably see that as being a worthwhile payment and a worthwhile premium, because they do get that connection and those added benefits that I'm not entirely sure they will get specifically from those businesses that are more providing, that payment service.
Yeah, right. Makes sense. What I like about that distinction, mate, is, and I actually tweeted about this during the week, but even though, to your point, I've made the case, and I don't know if you necessarily agree with me, that I think the PayPal product is technically, rationally a better product. It's cheaper, it's easier, it's simpler to use. If you already got a PayPal account, which I do, it popped up when I bought something literally this morning. I sent you guys a screenshot. It popped up on my screen. Hey, rather than using the credit card you usually pay, do you want to choose the pay in 4 option? If it's cheaper, more available, bigger user base, in theory, you might say, well, rationally, that's a better product, or at least has better features. But that's not it, right? As you say, excuse me, the customer retailer relationship, the ease of use, the cool factor. There's more than just the rational comparison of features, right? This sector is not going to be determined necessarily by the most rational behavior. Arguably, that's credit cards in general, right? Because if we're rational, we wouldn't pay 20% to buy a pair of shoes now rather than saving up for a month to buy them. So there's something about that decision, as you say, which is not just a matter of putting the features on paper and drawing a line down them and trying to work out which one's best.
Yeah, look, one of the things that I like about Afterpay is it is simple and it's not confusing to use. So it's a very simple interface. It's very easy to use. One of the things I'm not entirely sure about PayPal, and I get the angle that it is possibly a more rational sort of use case, but at the same time, they're offering a number of different methods of payment. So they've got bank account transfers, credit cards, payment after 21 days from delivery, and now also buy now, pay later.
Right.
I do, part of me does wonder whether or not that becomes more complex for the user to sort of make a decision. Yes, it's enhancing the use of the platform and the potential uses of the platform. But by comparison, if Afterpay can stay sort of simple and, market itself as a way to, help make finances easier to understand, then maybe that's another angle in which it can possibly win.
I think it's a really, I don't want to editorialize too much. This is your show, not mine. But it also reminds me that, to your point, if you think about the way it's done, PayPal does come across very much as a payments platform in I'm going to say a boring way, or if you think about and this is really hard to put into words, right? But if you think about using PayPal, the PayPal app, the PayPal engagement, that whole thing, it's kind of a bank account, right? It's a transactional kind of interface to make it easy to make payments, which is fine. Afterpay is designed almost, PayPal's a new business. It's 10 years old, maybe 15 years old, maybe 20 years old. Afterpay is kind of designed with exactly that in mind, as you say, mate. It's a more engaging offer. I don't use Afterpay, by the way, but it's a more engaging offering. It's a more engaging brand. It seems more personable. It's almost more a retail brand, whereas PayPal kind of feels more like a banking brand, and that's not, again, rationally, no big deal. But if you think about the potential target market, largely teens and early 20s, who are going to pick it up, are you going to actively go and find the PayPal app and download it? Or are you going to go and find the Afterpay app and download it? Even as an old bloke, I'm looking at this going, I absolutely see why people would choose Afterpay 3, 4, 5, 6 times to 1, just because it just seems like it's geared for them. And that's really intangible, hard to grab, but it's an important point.
And I think as well, Afterpay has basically become a verb. So, if you want to go and pay in 4, you say, I'll Afterpay it. I don't see I'll PayPal it becoming sort of that verb-like trend.
Right.
And in that sense, I suppose Afterpay sort of does have a first mover advantage. It has sort of solidified itself in that space in the consumer's mind.
I like it. All right, mate. So we've talked a lot about it. We've kind of half done the bull case. I've led you down a nice merry dance, but let's wind it back just a little bit. Just summarize for me, if you can. If you are going to make an investment in Afterpay, what are some of the key reasons you would do so? What are some of the key, we talk about the bull and the bear case in stock market jargon. The bulls are those who expect things to go up, who expect better market. A bull market goes up, a bear market goes down, or it's someone who's a bear is expecting bad things. So let's make the bull case. Let's make the case for investing in Afterpay. How would you summarize the key tenets of the investment case?
I think in terms of the bull case, I think there is in large part that merchant angle. So I mentioned a minute ago that the merchants do get a lot of advantages from using the Afterpay platform to connect with their consumers. So yes, it does charge, between, we'll say 3% for a very large retailer, 6% for a smaller retailer. And it can do that because it obviously has more, I guess, power in that relationship, in a smaller merchant relationship. I'll just read out some of these statistics though. So in terms of the customer base, so merchants find that 30% or more Afterpay customers are new to their brand. And that sort of goes again to, I guess, highlighting how its app and how its platform can actually connect consumers to brands that they may not even be aware of. So let's say you're a small regional merchant that all of a sudden wants to get Afterpay on their platform. If you're mainly connected, I suppose, to consumers through the summer months, because that's when tourism is high in your area, that's one thing. Right. What if you all of a sudden get Afterpay and are advertised on its platform? Yeah, you're still probably going to have that seasonal effect in Christmas time or whenever tourism is high, but at the same time, you're going to be getting more traffic, through that platform throughout the year. So I think that's a real advantage. Yeah. Increased sales, so lower upfront cost can boost the card amount by 40%. So again, imagine you're a retailer, you're used to customers spending $100 on your platform, and now all of a sudden they're coming through and spending $140. That's a lot.
Worth 5%. Yeah, exactly.
At the same time, they're also converting more of the carts. So like all of us, we've all been there where we've added a whole bunch of things to our cart and then forgotten about it, or exited the session and all of a sudden, it's almost like the customer's there at the desk and then just walks out and leaves it all on the bench without paying. It's devastating. So something like Afterpay coming in and actually helping to increase the conversion of that cart, I think is really beneficial too. And the other thing as well is, and I think this is actually an outdated figure. I think I saw about 31 million was the latest figure, but as of the half year, so December 2020, 27 million referrals per month on average through the year. And that's from its site. So again, I don't see something like PayPal or Apple, which I sort of envisage as being more of a payment option. I don't really see them having that same that same connection where they can actually help merchants to benefit more from consumers, as opposed to, I guess, providing consumers with more convenience. I think that's probably largely where they come in. I think another real thing to keep in mind here is that winners keep on winning. And we see this all the time. Everyone bets against the winner because the share price has skyrocketed. Oh, it's too late. And part of this is I guess, embedded in the framing bias. We see it at $10 one year and then it's $100 the next year. And we think, how the hell can it keep on going? Yeah, I missed out. Exactly. I'm not going to touch that. It's too high. Yeah. Winners can keep on winning. And look, Afterpay, in a traditional sense, it does look expensive, but I wouldn't bet against it. I'll just mention a couple of the growth figures as well. So in the third quarter of 2021, underlying sales were up 123% on a constant currency basis. And that's the amount that it helps to get to merchants, not necessarily its revenue, but the amount that it helps to get to merchants. In the United States and the UK, which are its two higher growth markets, up 211% and 277% respectively. So massive growth.
Remarkable.
14.6 million customers and also nearly 86,000 merchants on its books too. And yes, I've just seen there on my notes, 31 million lead referrals generated per month through this quarter. So it's just growing like a weed. Companies like that, I think it's too hard or too easy to assume that they're going to just fall and growth just drops off a cliff. I don't see that happening for Afterpay, even with these competitive threats. I would also say one more thing too. With companies like Apple and PayPal coming in, likely charging a lower fee for the merchant. At the same time, you still see those merchants paying high rates on other platforms. So whether that be a Google on a pay per click or a Facebook pay per click, Google ads, that can add up as well, maybe 10 to 15% of the sale. If those smaller retailers can actually, get charged between 3 and 6% through Afterpay. It may end up being a cheaper alternative anyway if they can continue to get that sort of conversion. So that's part of the bull case for me. I absolutely see that these competitive threats are a source of potential disruption, so I'm not discounting that. But at the same time, I do think that Afterpay has quite a unique position in this market that those businesses aren't going to immediately take away.
All right, now every time we do this, the bull case has me. I'm convinced. And then I ask you guys for the bear case, and that almost equally convinces me. And then I have to try and work it out at the end. The good news is I don't have to work it. I'm going to ask you to work it out at the end. But in the meantime, compel me with the bear case, mate. If you're going to try and talk someone out of investing in Afterpay, what would you highlight as some of the key, maybe risks, or maybe just simply lack of upside, whatever it is? Make the bear case for me. Convince me to sell my Afterpay shares. But I don't.
You know what? Before I do that, Scott, I'm going to give you one more case for the bull.
Oh, okay, all right.
Sorry, I let you jump the gun there. One more case for the bull. You've got, on the one hand, you've got the companies like Apple and PayPal encroaching on Afterpay space in the buy now, pay later section. Mm-hmm. At the same time, though, Afterpay isn't sitting still itself. So it's also innovating. It's also out there creating new solutions, new products. And it was just yesterday or the day before, actually, it announced Money by Afterpay, which we'll refer to as the Money app. Mm-hmm. And what it's really trying to do here, it's really, I guess, trying to act as the champion for consumers and for small retailers. So what it's trying to do with this, it's teamed up with Westpac, and it's basically offering consumers up to 15 individual savings accounts. And it's actually a pretty decent savings rate. I mean, relatively speaking, it's 1% savings rate, so it's still not great.
Interest rate on the savings accounts, is that right?
Sorry, say that again.
When you say savings rate, this is the interest rate on the savings accounts?
Yes, correct. Yep. Sorry. Yep.
Yep. Cool. That's right.
So 1% across 15 accounts, up to $1 million. And what it's really trying to do is it's really trying to, I guess, control that consumer finance perspective. So it even wants to implore people to basically have their salaries deposited into their Afterpay accounts and then spread it across their accounts like that. It wants that insight, and it wants that relationship straight up. And it's also doing that to help customers trust themselves with money management. Now, again, I think there's a bit of management spin on there. I don't think that's its core angle. I think there are probably different angles behind that, but I do think they can pull it off. I think if they can help consumers to understand and to give them a better oversight of their finances, then that is a good way that they can, expand that relationship and also potentially expand how much is spent on the Afterpay platform. So with that additional bull case in mind, I'll go into the bear case.
Right. Now you're gonna have to work extra hard on the bear case, mate. I gave you an extra bull once. You're gonna have to come up with some extra bear arguments. I want a balanced fight here. I want a fair fight. So the referee's got to do it on points when we get to the end. So give me with the bear
I'll
case.
do my best.
Convince me I should sell if I own the shares.
Look, competition is definitely heating up. So Afterpay took the world by storm, didn't it? I mean, the growth in those first few years, and even still now, but particularly in those first few years, was just stunning, phenomenal. It was a model that wasn't very well understood. I didn't have a great understanding of it either. I sort of questioned, how can this work? How can this be sustainable? They have proven, or at least to this stage, that it is sustainable and it is quite lucrative. And that's why you've got companies like PayPal and Apple coming into the space.
That's the problem, right? Success invites competition. That's almost the point.
That's right. Yeah. So competition is absolutely a concern. And I think that in itself will limit how much Afterpay can charge the merchants. So I mentioned a minute ago that I think it can still charge more than what a company like PayPal or Apple could. But I do think that will be limited because of the number of options that are available to those merchants. So I think that does put a ceiling there. Those companies as well that are expanding into this buy now, pay later space, they have incredible scale and reach. So you've got companies like Apple, which have, I don't know, what is that, 100, 200 million iPhones out there. I'm probably way off with that, but that's reach, and it's already
a large number.
It's in consumers' pockets. It's on consumers' desks in terms of the iMac or MacBook. So they have enormous reach. People trust them. Same as PayPal rather. People trust them. They've got that name. So there is that angle too. I think there are still regulatory angles that Afterpay may need to be concerned about, or at least keep an eye on. So part of Afterpay's contract with the merchants is that the merchants do not tack on a surcharge to cover the merchant fee. So let's say Afterpay is charging a merchant 6%. They want to say that it's Afterpay is free to the user. They don't want that merchant then going on and basically making the product 6% more expensive to cover that cost. That's part of the contract.
So you pay $100 for your jeans, plus you pay another $6 for Afterpay fee or something. So you pay $106 at the counter, covering the merchant's fee, which kind of undermines the whole idea, right?
Exactly right. And it's my understanding that a company like PayPal isn't going to do that, or isn't going to include that in their contract. I should also mention, by the way, the news of Apple expanding into this space is not definitive at this point. And I think there's a pretty good chance that it will. It's sort of been spoken about or rumored for quite a while, but there's been no official announcement from Apple that I'm aware of. It's sort of just on the rumor mill. Seems like a pretty strong rumor at the minute, so we'll say it's going ahead, but there is, I guess, potential for it to change. Nice. Margins will probably be compressed. I think there may potentially come a time where user growth slows down because of this. I think companies, we mentioned a minute ago, there's about 7 different companies on the ASX that are in this buy now, pay later space. I think other companies other than Afterpay are probably more at threat here. I think Afterpay has sort of solidified itself as one of those top dogs, which probably provides it with some element of protection, as well as the fact that it's, innovating elsewhere. But I would say that with more and more alternatives coming out, and also more flexibility for the consumer, that may stump Afterpay's growth at some point, and that's part of the bear case, I suppose. The other part as well is the stock isn't. I mentioned a minute ago, the stock isn't cheap in a traditional sense. So $30 billion market cap. In the 12 months to the 31st of December, they had $670 million in sales. So we're looking at about 45 times price to sales. The company also isn't
large.
It's large, and the company isn't profitable yet.
Right.
So, and look, I do believe they can become profitable. I think over time, as they stop marketing quite so much, as they stop awarding so many share-based payments to their employees, then that profit can start ticking up. But in the meantime, it's off the charts. So I would say that's one of the big bear cases. If it was 5-10 times sales, I would think it's a no-brainer at this point because of those differences that I mentioned before. But the fact that it is quite expensive in a traditional sense, at least, that's a bear case for it.
I did some numbers not long ago, Ryan, to your point about valuation, and I want to say Afterpay's market cap was something like a quarter of that of American Express. And even for someone who I'm not a hyper growth investor, but I don't mind taking some risk on valuation. I'm an Amazon shareholder, for example, happily so, and that defies most traditional metrics as well. When I saw Afterpay was worth something like a quarter of Amex, there was a sharp intake of breath at that point. I did think, oh, hang on, Amex is in 100 and something countries. It's been around for 100 and something years, and Afterpay is kind of trying to usurp the traditional payment methods and networks and get that big. To me, that's kind of, to your point about the bear case and the valuation, it gives you some sort of sense of the mountain yet left to climb, right? Your 45 times sales, obviously an infinite price earnings because there isn't any earnings. And it has to do a lot just to justify the current price. Maybe in the context of the bear case, mate, I guess I'm trying to frame this up for our viewers. What happens to Afterpay to get to that level? I mean, it's going to have to grow for X number of years just to grow into a current multiple, let alone get growth from there. If you look out a period of time, without wanting to be bull or bear yet, we'll get to that in a minute, but what kind of stuff would it have to do to justify that valuation? If you just do the maths, irrespective of a view either way, if you're looking at a company like that and someone says, hey, this thing is at 45 times sales, you'd say, I would buy this if. How would you finish that sentence? Is it a certain amount of growth, a certain number of years worth of growth? How do you kind of conceptualize that just in your own mind?
So I mentioned a minute ago that for the past few years and even in the last quarter, the quarter ended March 2021, the company has been growing at triple digits. So the most recent quarter, I think I said 123%. And look, I think there was likely a boost there from the COVID impact. People are all of a sudden buying online. I mean, that said, Afterpay is also available in store, and that was obviously impacted through the pandemic as well. So there was sort of a bit of an offsetting impact there. That said, I think if the company can continue to generate strong growth to that magnitude for a couple of years, then all of a sudden that those price to sales and price to earnings ratios, or the price to earnings, I guess, is non-existent. And price to sales in particular, that can start to look a little bit more reasonable. So let's assume, for the case of this, that Afterpay sales grow 100% again in the second half, and all of a sudden it's got, I don't know, let's just say round figure $1 billion in sales for the previous 12 months, ended June 2021. All of a sudden, that trailing price to sales ratio might be 30 times rather than 45 times. Right. Still high, but looking more reasonable.
But if it doubles again, it becomes 15. If it doubles again, all of a sudden it's 7.5 times sales, and that looks pretty cheap in 3 years' time if you can do those sort of numbers.
Exactly, and the company,
maybe it's not overly expensive.
maybe not cheap. Yeah, let's not say that. But again, we said before, a lot of these companies they never or very rarely look cheap. The company is also expanding into, in particular, European markets at the minute, and that itself has the potential to really put a rocket under that sales base. I think there are a couple of different angles that the company can take to start to grow into that valuation. But yes, agreed, it does look expensive.
All right, mate. You've been very generous with your time. I think we've given our viewers a very thorough understanding of Afterpay. We've looked under the bonnet. We've discussed the competitors. We've made the bull and the bear case. I'm going to put you on the spot. I'm going to ask you to look out, I'm going to say 5 years, because this is going to be, look, you're not going to confirm an investment thesis in 3 years unless growth is astronomically larger than it has been in the past. So let's go out 5 years plus. The market's probably going to average what it has in the past. Maybe that's 9-10% a year in terms of market growth. So if Afterpay is going to beat the market, it's probably going to do something like that over the next 5 years, plus something on top of that. Again, maybe we have recessions and drawdowns and stuff, but let's assume that. The big question for me is, I can buy an ETF today, or I can buy Afterpay shares. I can buy other companies as well, but let's look at Afterpay versus the market. I'm going to put you on the spot. If you were to look out 5 years from now, given all the good stuff, given all the bad stuff, given the astronomical price to sales and the lack of earnings, is Afterpay, to your mind, a market beater over the next 5 years, or will the market win this particular race?
Look, over the next 5 years, I think it can be a market-beating stock, Scott. I think, particularly in the short term, there is still that, the uncertainty of what's going to happen with the new competitors. So, as you said, I don't think an investment case can play out over such a short period of time. 5 years, though, I think this company can continue to innovate and continue to make itself increasingly relevant to millennials in particular and other younger generations, but I guess also older generations too. By continuing to do that, I think it can, as I said, grow into that $30 billion market valuation and probably expand on it as well. It is going to take some work. There is uncertainty involved, and I guess there always is with investing. But yeah, I do think it can be a market-beating stock over the next 5 years.
Nice, Ryan. I love that. Thank you, mate. That's really exciting to hear. Phillips, before we go, just a reminder that any advice we do give is obviously general in nature, and we should say that we always recommend you be diversified. Whether we make buy recommendations formally in our services or simply share with you here some thoughts as to whether or not we think a company can be market beating, we're going to be wrong sometimes. I'm not saying Ryan's wrong this time. He's probably right. But remember that you should always be diversified. Make sure that your winners and losers are in the same portfolio together, because that's how we win as investors. Even the best investors are wrong 2, 3, 4, or 5 times out of 10. So keep that in mind when you are investing in any stock, not just Afterpay, by the way, but whether you're buying CBA, which we covered in our first episode, CSL, Afterpay, or anything else we cover in the weeks and months ahead, please be diversified. Please make sure it's part of a broader portfolio. Ryan, you're on Twitter. How can our viewers follow you on the Twitter machine?
TMF Newmy, Newmy.
There you go.
It's a nickname I picked up in high school.
Given your name's Ryan Newman, I reckon our viewers can probably work out how it came about. I assume it's not anything other than your surname, but if it is, feel free to share that story with us. You should follow Ryan on Twitter. He's a very smart bloke. We are very fortunate to have him in the team, and we've probably talked for longer than I intended to, but it was such a great conversation that I'm sure you've enjoyed it every bit as much as we have. Please make sure you do like this video, like our channel, and subscribe. Make sure you hit the notification bell, because when the next one of these comes out, plus, by the way, we do stock of the week, we do our media appearances. There's going to be a heap more content on this YouTube channel coming up. You don't want to miss it. It's free. Man, where else do you get such high quality free investing content? I would say almost nowhere except here on the Motley Fool Australia YouTube channel. Ryan, thank you for spending your time and sharing your intellect and experience with us. Fools, I hope you've enjoyed it. And until next time, Fool on.